I would describe timeframes as underrated, overcomplicated, extremely vague nowadays, but arguably the most important thing about trading. So since those timeframes are so important, I'm going to exactly tell you how to use those timeframes in your trading. And in order to do that, we are going to go over 5 steps. And those 5 steps are, again, the foundational levels. Everything that we do in trading comes back down to the foundational levels. So to get to a trade outcome, we need to follow the following 5 steps. We have a bias, a narrative, a context area, then we have an entry, and then we have our risk management. At every step, we use different timeframes. First things first, let's get one thing really clear as well. I only use the following timeframe: monthly, weekly, daily, 4 hour, 1 hour, 50 minute, 5 minute, and 1 minute. Might seem like quite a lot, but it's really not if you understand the foundational levels as well, which we are going to go over. That is usually where the overcomplications start. So if I can give you one piece of advice as well, if you are not profitable, remove the 30-minute time frame, remove the 1.5 milli-nanosecond time frame, remove the 4.5 time frame, the 5-hour time frame. It's all unnecessary. Let's keep it simple, as simple as possible, by just using those time frames. So in step number 1, which time frames do we use? The higher time frame. And what is the higher time frame? That is the monthly, the weekly, the daily, and the 4-hour. Those 4 time frames are defined as the higher time frame. And we want to start at the highest time frame of those 4 time frames, so the monthly time frame, to find our bias. So right here, if we take a look at this market, we are on the monthly time frame first, then we can see right here that we have been moving higher overall, which we can simply see, again, does not have to be complicated. The most recent candles right there have been up candles. So the first question that goes through my mind, okay, if the monthly right there has been going higher, what is it potentially aiming for? Well, very easy targets could be a previous month high right there and a previous month low. So whilst this candle is currently forming, where are we most likely heading towards first? The previous month's low or the previous month's high? I would argue, since we are already going higher as well, I would argue that the arguments are stronger that we are indeed going to first trade towards the previous month's high. And then afterwards, we could look at this swing high right there as a potential next target as well. So the monthly can already do a lot of work right here, can already take away a lot of confusion that we might have about the overall market direction. Then once we go down in time frames right now, so we might go into the weekly, the daily, and the 4-hour, we simply want those time frames to agree with the time frames above. So the weekly should agree with the monthly. The weekly should ideally also be bullish. Daily should agree with the weekly. So the daily should ideally also be bullish. And once you have all those in agreement, that's when you have a strong bias and a clear direction and a clear target. If the monthly is bullish, the weekly is bearish, the daily is bullish again, 4 hours bearish. If all those are contradicting themselves, then that is going to be low probability and not going to be clear price action. So that could be a moment where you would want to stay out of the market. So the first step is already done, but now the narrative comes in. The narrative is the following. If we are going higher right there, where are we going higher from? So here we have this drawn liquidity, that is the target. How are we going to deliver towards that target? This is where I like to use fair value gaps. So on the monthly, I simply want to ask myself, do we have a fair value gap in recent price action right here that we could sting back into, so retrace back into right there, to then continue higher off of? Well, no, we don't have that. Okay, perfectly fine. So then you are allowed to go down a time frame to now find yourself a fair value gap that we could continue higher off of. Right here, do we have any fair value gap that we could now continue higher off of? No, the recent fair value gap right there has already been stinged into, so there is no fair value gap after that as well, but we still continue higher. Okay, so now we can go into the daily time frame to find that narrative. Then here on the daily time frame, what do we see? We have this daily fair value gap. An extra confluence for the bias is also that we had this bearish daily fair value gap, which now has been disrespected by a new bullish daily fair value gap right there as well. Perfect. So here we actually had this bullish daily fair value gap, which we could have continued higher off of at that moment in time, which is exactly what we are currently seeing. Now, when you are just starting out on your trading journey and you're trying to find profitability, I would argue stick to the monthly, weekly, and daily for your narrative at first. And then afterwards, potentially go into the 4-hour. But it's important to understand, even I personally, I do not rely on only 4-hour narratives. So what that means is, if we do not have monthly, weekly, and we do not have daily narrative, so for example, if we did not have any fair value gaps going higher right there, and we did not have a clear narrative, then I would not go into the 4-hour to force an ID. It starts on the monthly, weekly, daily. If there's narrative on the monthly, weekly, daily, perfect. Now you can go into the 4-hour. So off of this daily fair value gap right there, now we are potentially creating a new daily value gap, which could also be interesting. And we also have 4-hour fair value gaps right there, which we could potentially continue higher off of right there as well. So now we can go into the 4-hour right there because we are coming off of daily narrative. So we understand what we might continue higher off of right here. We had that daily fair value gap and also the 4-hour right there. That's nice and all, but now we need to go over the third step, which is context. The context is very crucial because context will tell us where we are allowed to look for an entry and on which time frames we want to do that. For context, we are going to work our way down in time frames slowly as well. So we started off with bias on the higher time frame, narrative as well, again, the higher time frame. Context is going to be the same time frame as your narrative time frame. So right here we had daily narrative, for example. That is also your daily context. You don't go down in time frames to now go look at the 4-hour if you already have daily context. If you work your way down and you find that narrative right there, then that narrative is what you want to stick to. So here on the daily, do we have new context overall? No. So this is where we are coming off of daily context as well. So that daily context, again, is quite important to understand. We are coming off this discount rate. The first premium rate that we are running into is that previous day high right there. So we have recently come off a context area. Context area being the move from the discount rate to the first premium rate. That right there is the area that you can look for your entries. After this context area right here on the daily is finished and we have recently come off that daily value gap, we can still go into the 4-hour as well. It's just important that the daily right there is responsible for pushing price higher right now. Where we can either wait right here for a daily new context as well of the daily value gap, or we can also go right here into the 4-hour time frame. Now, to know which one you want to use, if you want to wait for the daily right there, or if you want to go into the 4-hour, it's important to understand if there's a reason to create a retracement into the daily value. Meaning, do we have towards the left right here, an order block, a fair value gap sitting right there on the same time frame as that we are creating the fair value gap that could push price lower back into the fair value gap. So for example, in this scenario, here towards the left, we have this order block sitting right there and this fair value gap as well. Both are responsible that price pushes lower a little bit back into that fair value gap to then eventually again continue higher for a little bit. Where here at this moment in time, we do not have that. So I would not necessarily expect that third candle to become a big retracement or anything. And if that does happen, I would be very suspicious that we might not want to continue higher anymore. So for me, if we sting into that 4-hour value gap right there, I would already be perfectly fine to look at a potential entry right there. And now we have 4-hour context because we are again coming off that daily value gap right there. In that 4-hour context, again, there's no reason right here to go on the 1 hour to look at the 50-minute, etc. You can simply wait for the 4-hour retracement right here and then wait to potentially look for your entry. Now, let's take it one step back right here to show you an entry example as well. If we want to continue higher right here, then we have that daily value gap, which we can continue higher from, where we obviously already saw the move back into where we already continued higher. So that right here creates a context area where until we reach that high right there, we can look for an entry. Again, no going into the 4-hour right here, no going into the 1 hour right there to look for a fair value gap higher. And the reason for that, it's quite important to understand, is because we want everything, again, like we mentioned earlier on, we want everything to be in context of one another. So we have the context area, but we also have something called the relativity theory again, where if the daily is bullish and the 1 hour right there is bearish, then we want to stick to the daily because the daily is the higher time frame. And if we have a fair value gap, for example, right there, And at this moment in time, that 15-minute fair value gap is something we want to trade off of. But we also have a daily fair value gap sitting right there. Then again, since the daily has a fair value gap below that 15-minute bullish fair value gap, both bullish fair value gaps, then it's most likely that we will retrace back into the daily fair value gap to then continue higher, because it's on the higher time frame, and the higher time frame rules as the stronger PD raise. So the magnet towards that daily fair value gap is stronger, and that right there will cause that 15-minute fair value gap to eventually not hold. So that's why we work our way down timeframes instead of jumping to the other time frame to the other time frame. Now, once we sting into that daily fair value gap right there, we can move on towards the next step. And the next step is an entry. And for our entry is where we can now move into the lower time frame. And again, for simplicity's sake, I want to refer to the lower time frame as 1 hour and below. Now, in just a few moments, I will give you the time frames that I use for my entries as well. But if you want to experiment with your own timeframes, and I would definitely advise it as well, go take a look which timeframes work for you. Then keep in mind, the further the context timeframe and the entry timeframe are apart from each other, the more confirmation you are going to need. What do I mean by that? Well, here we have a daily fair value gap, daily narrative, context, which we can continue higher off of. If I want to confirm that daily fair value gap on the 1 minute time frame, those two timeframes are very far apart from one another. So I'm going to need a lot more confirmation on that 1 minute time frame than if I were to use, for example, the 4 hour. I could just simply use one candle to confirm the daily fair value gap. But if I go into the 1 minute, I need a lot of confirmation. So depending on how you combine the time frames, that tells you how much confirmation you're also going to need. So if I use the daily and the 1 hour, for example, where I use the 1 hour as my entry confirmation, of that 1 hour, I would only need, for example, a 1 hour fair value gap higher. Where if I refer to a sharp turn, then you'll see I refer to these time frames that are on your screen right now. Where on the daily right here, I would go into the 1 hour right there to confirm the sharp turn, because those time frames are closer to one another. So I can indeed use the sharp turn to my advantage, because again, I don't need a lot of confirmation. So the sharp turn right here, what is a sharp turn? The fair value gap going in right there creates the manipulation part, and then the sharp turn is finished once we have that fair value gap going out as well. That right there creates the sharp turn. Where here, the sharp turn, we could argue, would have not really been a nice entry, because the entry right there would have been very high if we want to enter on the confirmation of that sharp turn as well. Now, if we're not talking about sharp turn entries, I confirm my PD raise the following way. So I use the following entry timeframes here again on your screen. Where here on the daily fair value gap, I would want to use the 15-minute time frame. And when I refer to the 15-minute time frame, I would like to use the following entry confirmation, a fair value gap higher right there, and then I want to see another fair value gap higher. So essentially, I want to see two fair value gaps higher right there. When we get this fair value gap higher, and we get another fair value gap higher right there, at the close of that third candle, so when the fair value gap is confirmed, that in itself for me is already an entry covering the low right there, targeting a 1 to 2 RR as well. But then when do we actually use, for example, 1 minute entry confirmations? Because when do we use 1 hour context areas? So when we want to use 1 hour context areas, very similar to when we want to use 4 hour context areas, not just at any given moment in time. We would want to use 1 hour and, for example, even 15-minute context areas when we are just coming off of a daily context area. So when we are moving higher here off the daily, we create a 1 hour narrative and context area in the form of this fair value gap right there, which we do not actually sting back into. So we never had a chance to confirm that on, for example, the 1 minute time frame. But if right here we go into the 15-minute, then we see that this 15-minute fair value gap right there is created off of the daily fair value gap. So this 15-minute fair value gap, you can actually confirm that through. And what I mean by that is you can go into the lower time frame, into the 1 minute time frame right now, or even a 5 minutes, again, which time frame you prefer, to then confirm it again. And since we are just coming off of a daily fair value gap right there, there is no other fair value gap that could mess with us. Meaning, at this moment in time, below this fair value gap, there is no 4 hour value gap, there's no 1 hour value gap, we are just coming off a daily fair value gap. So there is no chance for a bigger retracement than that 50-minute fair value gap right there, because there's no reason to. There's no higher time frame fair value gap below that 50-minute fair value gap right now that we haven't already had a sting into. So here we could even go again into the 5-minute to confirm that 15-minute fair value gap, where we only need realistically one fair value gap going higher right there. And that is enough of an entry opportunity right there, which we could already look for an entry off of, or choose the order block right there. Again, personal preference, whatever you want. And then we can even go into the 1 minute right there off of the 50-minute fair value gap that we saw. Where on the 1 minute, oftentimes you only need, again, a sharp turn right here to continue higher right there off of that. If you do notice quite a lot of losses on the 1 minute right there off of those entries, then it might be better to look at the 5 minute instead, or don't look at the 1 minute at all, because you don't really need it if you're just starting out with trading. And even later on in your trading career, I would argue you don't really need it to be successful. So let's assume that we took this entry right there at the close of that third candle, confirming the overall entry confirmation that we wanted to see. And now we are going to move on towards the last step, which is risk management. So which timeframes do we now use for our risk management? We want to use the following timeframes. It depends on what the context timeframe was. The context timeframes that we used was the daily, because that is the context area that we are trading off of. It's a daily context area, daily fair value gap that we are confirming. And then the next step was the 50-minute timeframe. So we have the context daily, and the 50-minute was our entry time frame. Then from the 15-minute until the daily time frame, those are the time frames that we want to use. So to sum that up, the time frame that you used for your context area and the time frame that you used for your entry time frame, then the entry time frame until you reach the context time frame is the time frames you want to use. Might seem very confusing. Let me clear that up again. So here we would want to use the 15-minute, the 1 hour, and the 4 hour. If you look at a weekly PD array and you're confirming that on the 1 hour, you want to look at the 1 hour, 4 hour, and the daily to confirm that. So it's always those 3 time frames. And if we look at a monthly PD array, we're looking to confirm there's going to be weekly, daily, and the 4 hour. So to make it easy, here's a list and you can take a screenshot if you want to. So here we want to use the 15-minute, the 1 hour, and the 4 hour right there to confirm when we can go break even, because that is essentially what we want to do. That is our focus for the risk management part. Now, the reason we use 15-minute, 1 hour, and 4 hour is because on those time frames, we want to see if there is a reason that we might still want to retrace. What could be that reason? Well, a reason that we oftentimes want to still retrace is a fair value gap below our entry, for example. So let's look at the 4 hour right here. And whilst the 4 hour is actually forming, the 4 hour is not something we would have been worried about because we do not even create a fair value gap before we reach that take profit right there. So nothing to worry about. There's no fair value gap that we can retrace back into. Let's look at the 1 hour. On the 1 hour right here, we could argue that we have a 1 hour fair value gap right there sitting exactly below our entry. So once this third candle closes, we need to ask ourselves, is there a reason for price right now to retrace back into that fair value gap before we want to continue higher right there? This is where I would already want to go break even. And I'm going to refer to a breakaway gap video that's very important to understand for the reason why I go break even right there. I'll link it at the end of the video. And on the 50-minute, we need to see, okay, on the 50-minute, is there a reason for that retracement into that fair value gap right here, for example? Well, what do we see? We already have a fair value gap right there sitting above our entry. When that is the case, and we are that close to the overall drawn liquidity and the take profit, you can already go break even when we have a fair value gap above our entry level right there. And then eventually, when we go break even and we hit take profit, all is perfect, of course. Now we can just apply the same and we can potentially see what is going to happen. And if this 4 hour value gap right here even wants to hold, do we even want to retrace back into it? Will be very interesting to study as well. This is how we use the timeframes, or how I at least would advise to use the timeframes. Timeframes is at the foundation of everything that we do in trading. So it's extremely crucial to understand how you want to combine them as well with one another. So please do spend time looking at which timeframes you also want to use. And then again, I'm going to refer to the breakaway gap video, which you can watch after to understand why I went break even right there. All right, perfect. Thank you.